Welcome to Chapter 8. These next two chapters will continue our study by investigating the measurement and reporting issues involving inventories and the related expense, cost of goods sold. Inventory refers to the assets a company intends to sell in the normal course of business and has in production for future sale, which would be work in process, or uses currently in the production of goods and services to be sold, which would be raw materials. Now, the computers produced by Hewlett-Packard that are intended for sale to customers are inventory, as are partially completed components, the computer chips and memory modules that will go into computers that produced later. The computers used by Hewlett-Packard employees to maintain its accounting system and other company operations are not available for sale to customers and therefore are classified and accounted for as plant and equipment. Similarly, the stocks and bonds a security dealer holds for sale are inventory, whereas HP would classify the securities it holds as investments. Cost of goods sold is the expense related to inventory. Inventory usually is one of the largest assets listed in the balance sheet for manufacturing, wholesale, and retail companies. Those are enterprises that produce revenue by selling goods. Similarly, cost of goods sold typically is the largest expense in the income statement of these companies. There are two types of companies that we're going to be dealing with: a merchandising company and a manufacturing company. Each have unique types of inventory. For merchandising inventory, wholesale and retail companies purchase goods that are primarily in finished form. These companies are intermediaries in the process of moving goods from the manufacturer to the end user. They often are referred to as merchandising companies, and their inventory as merchandise inventory. The cost of merchandise inventory includes the purchase price, plus any costs necessary to get the goods in condition and location for sale. While manufacturing inventories, unlike merchandising companies, they manufacture or produce the goods they sell to wholesalers, to retailers, or other manufacturers. Inventory for a manufacturer consists of raw materials, work in process, and finished goods. So raw materials are the cost of components purchased from other manufacturers that will become part of the finished product. For example, Hewlett-Packard's raw materials inventory includes semiconductors, circuit boards, plastic, and glass that go into the production of personal computers. Work in process inventory refers to the products that are not yet complete. The cost of work in process includes the cost of raw materials used in production, the cost of labor that can be directly traced to the goods in process, and an allocated portion of other manufacturing costs called manufacturing overhead. Overhead costs include electricity and other utility costs to operate the manufacturing facility, depreciation of manufacturing equipment, and many other manufacturing costs that cannot be directly linked to the production of specific goods. Finished goods are goods that have been completed in the manufacturing process but have not yet been sold. They have reached their final stage and now await sale to customer. Their cost includes the cost of all raw materials, work in process, used in production. Manufacturing companies generally disclose, either in a note or directly in the balance sheet, the dollar amount of each inventory category. So, for example, Intel, one of the world's largest semiconductor chip manufacturers, reports inventory as shown here on this slide. The inventory accounts and the cost flows for a typical manufacturing company are shown using T accounts on this slide. The cost of raw materials used, direct labor applied, and manufacturing overhead applied flow into work in process and then to finished goods. When the goods are sold, the cost of those goods flows to cost of goods sold. We focus in this text primarily on merchandising companies, Still, most of the accounting principles and procedures discussed here will also apply to manufacturing companies. The unique problems involved with accumulating the direct costs of raw materials and labor and with allocating manufacturing overhead are addressed in managerial and cost accounting textbooks. So 2 accounting systems are used to record transactions involving inventory: the perpetual inventory system and the periodic inventory system. Now, the perpetual inventory system was talked about in Chapter 2. The system is aptly termed perpetual because the account inventory is always adjusted for each change in inventory, whether it's caused by a purchase, a sale, a return by the company to its suppliers, or a sales return for the seller. The cost of goods sold account, along with the inventory account, is adjusted each time cost of goods are sold or are returned by a customer. An important feature of a perpetual system is that it's designed to track inventory quantities from their acquisition to their sale. If the system's accurate, it allows management to determine how many goods are on hand at any date without having to take a physical count. However, physical accounts of inventory are usually made anyway, either at the end of the fiscal year or on a sample basis throughout the year, to verify that the perpetual system is correctly tracking quantities. Differences between the quantity of inventory determined by the physical count and the quantity of inventory according to the perpetual system could be caused by system errors, theft, breakage, or spoilage. In addition to keeping up with inventory purchases, a perpetual system also directly determines how many items are sold during a period. When a company uses a perpetual inventory system to record inventory and cost of goods sold transactions, merchandise cost data also is included in the system. That way, when merchandise is purchased or sold, the system records not only the addition or the reduction in inventory quantity, but also the addition or reduction in the cost of the inventory. The cost of goods sold account, along with the inventory account, is adjusted each time goods are sold by a customer. Here we apply this concept to Lothridge Wholesale Beverage Company, whose inventory information is provided. So as you see here, it tells us that the Lothridge Wholesale Beverage Company purchases soft drinks from producers and then sells them to retailers. The company begins in 2018 with inventory of $120,000 on hand. The following information relates to inventory transactions during 2018. Additional soft drink inventory is purchased on account at a cost of $600,000. Sales for the year, all on account, total $820,000. The cost of the soft drink inventory sold is $540,000. Lothridge uses the perpetual inventory system to keep track of both inventory quantities and inventory costs. The system indicates that the cost of inventory on hand at the end of the year is $180,000. So first we record the purchase of merchandise inventory for 2018 with a debit to the inventory account for $600,000 and a credit to accounts payable for the same amount because the purchase is made on account. Next, we record the sales for 2018. The sales were made on account, so we debit accounts receivable for $820,000 and we credit sales revenue for the same amount. Finally, we record the cost of sales sold with a debit to the cost of goods sold for $540,000 and a credit to inventory for the same amount. Now, under a periodic inventory system, it's not designed to track the quantity or cost of merchandise. The merchandise inventory account balance is not adjusted as purchases and sales are made, but only periodically at the end of a reporting period. A physical count of the period's ending inventory is made and costs are assigned to the quantities determined. Merchandise purchases, purchase returns, purchase discounts and freight in, purchases plus freight in less returns and discounts equals net purchases. Those all get recorded in temporary accounts, and the period's cost of goods sold is determined at the end of the period by combining the temporary accounts with the inventory account. So as you see here, the cost of goods sold would equal the beginning inventory plus the net purchases minus the ending inventory. So we're going to take a look at the periodic system using the Lothridge Wholesale Beverage Company example. So we know, as we talked about earlier, the various items, but now we're going to use the periodic inventory system for all the same information. So first we record purchases made during the year by debiting purchases for $600,000 and crediting accounts payable for the same amount since they're made on account. Next, an entry is made to record sales on account. No entry is recorded for the cost of inventory sold. Now, because cost of goods sold isn't determined automatically and continually by the periodic system, it must be determined indirectly after a physical inventory count. So as you see here, this shows how the cost of goods sold will be determined for 2018. We'll take our beginning inventory. We'll add our purchases minus our ending inventory to then yield the cost of goods sold in the period. Now this journal entry combines the components of cost of goods sold into a single expense account and updates the balance in the inventory account. It adjusts the inventory account to the correct period end amount, closes the temporary purchases account, and records the residual as cost of goods sold. Beginning inventory plus net purchases during the year is the cost of goods available for sale. The main difference between a perpetual and a periodic system is that the periodic system allocates costs of goods available for sale between ending inventory and cost of goods sold periodically at the end of the period. In contrast, the perpetual system performs this allocation by decreasing inventory and increasing cost of goods sold perpetually each time goods are sold. The impact on the financial statements of choosing one system over the other isn't significant. The choice between the two approaches usually is motivated by management's control considerations as well as the comparative cost of implementing them. Perpetual systems can provide more information about the dollar amounts of inventory levels on a continuous basis, but they also facilitate the preparation of interim financial statements by providing pretty accurate information without the necessity of a physical count of inventory. On the other hand, a perpetual system may be more expensive to implement than a periodic system. This is particularly true for inventories consisting of large numbers of low-cost items. Perpetual systems are more workable with inventories of high-cost items, such as construction equipment or automobiles. However, with the help of computers and electronic sales devices, like cash register systems with barcode scanners, the perpetual inventory systems now available to small businesses that previously couldn't afford them and is economically feasible for a broader range of inventory items than ever before. So the periodic system is less costly to implement during the period but requires a physical count before ending inventory and cost of goods sold can be determined. This makes the preparation of interim financial statements more costly unless an inventory estimation technique is used. And perhaps most importantly, the inventory monitoring feature provided by a perpetual system aren't readily available. However, it's more important to remember that a perpetual system involves the tracking of both inventory quantities and costs. Many companies that determine costs only periodically employ systems to constantly monitor inventory quantities. So let's take a look at our first concept question. The Golson Company uses the periodic inventory system. Information for 2018 is as follows. We have our sales, our beginning inventory, purchases, purchase returns, and ending inventory. So our cost of goods sold for 2018 will be the beginning inventory plus our purchases minus our purchase returns minus our ending inventory to give us $564,000 in cost of goods sold. Next, the Golson Company uses the periodic inventory system. Ending inventory, in this case, will be the 340 plus the 600 minus the 6,000 purchase returns, and it gives us the cost of goods sold. So we need to then plug in for the ending inventory, which as you see there is $370,000. So let's look at exercise 8.1. Exercise 8.1 says Jerome's Specialty Store uses a perpetual inventory system. The following are some inventory transactions for the month of May, year 1. Jerome's purchased merchandise on account for $5,600. Freight charges of $400 were paid in cash. Jerome's returned some of the merchandise purchased in 1. The cost of the merchandise was $700 and John's account was credited by the supplier. Merchandise costing $2,500 was sold for $5,400 in cash. Our job to prepare the journal entries to record all these transactions. So the first thing we're going to do is show the inventory. Purchased inventory, $5,600. Credit accounts payable for $5,600. We'll also show the freight charges as inventory and credit our cash since they were paid in cash credit cash there. Next, we're going to show how Jerome returned some of the merchandise. So we'll debit our accounts payable and credit our inventory. And then, as far as selling products, we debit our cash for the amount, $5,400. We credit our sales revenue. We also have to debit the cost of the goods sold of $2,500 and credit our inventory to show those goods were sold. If we look at 8.2, we're going to use the periodic inventory system using the exact same information. So, the first thing we're going to do, instead of using the term inventory, under the periodic system we use purchases and accounts payable. Then for the freight, it won't go into inventory, it goes into an account, freight in, debit. Then returning the products, we debit our payable, but look at this. We're not going to credit purchases, we're crediting purchase returns. Then last, we're going to show our cash and we're going to show our sales revenue. We do not show any journal entry showing the cost of goods sold under the periodic method. Regardless of the system used, the measurement of inventory and cost of goods sold starts with determining the physical units of goods. Typically, determining the physical units that should be included in inventory is a simple matter because it consists of items in the possession of the company. However, in some situations, the identification of items that should be included in inventory gets more difficult. Consider, for example, goods in transit, goods on consignment, and sales returns. So at the end of a reporting period, it's important to ensure a proper inventory cutoff. This means determining the ownership of goods that are in transit between the company and its customers, as well as between the company and its suppliers. So if both companies have December 31st fiscal year ends, whose inventory is it on December 31st, 2018? In other words, which company will report these goods and ending inventory in the balance sheet as of December 31st, 2018? Well, the answer depends on who owns the goods. Ownership depends on the terms of the agreements between the two companies. So if goods are shipped FOB, free on board, shipping point, then legal title to the goods changes hand at the point of shipment when the seller delivers the goods to the common carrier, like a trucking company. In this case, the purchaser is responsible for shipping costs and transit insurance. Lothridge records the sale of inventory on December 29th of 2018, and Jabbar records the purchase of inventory on that same day. Jabbar will include these goods in its 2018 ending inventory, even though the company is not in physical possession of the goods on the last day of the fiscal year. But on the other hand, if the goods are shipped FOB destination, then the seller is responsible for shipping, and legal title doesn't pass till the goods arrive at their destination, which is the customer's location. So in our example, if the goods are shipped FOB destination, Lothridge includes the goods in its 2018 ending inventory, and the sale is not recorded until January 3rd of 2019, when those goods reach Jabbar. Jabbar also will wait until 2019 to record the purchase. So Barrington Corporation uses the periodic inventory system. At December 31st of 2018, the end of the company's fiscal year, a physical count of inventory revealed an ending inventory balance of $80,000. The following items were not included in the physical count: merchandise shipped to a customer on 12/28, FOB destination. Merchandise arrived at the customer's location on January 5th of 2019. Merchandise shipped to a customer on 12/29 FOB, shipping point. Merchandise arrived at the customer's location on 1/2/19. Merchandise purchased from a supplier, shipped FOB destination on 12/26, arrived on January 4th, 2019. What is Barrington's 2018 ending inventory amount? Well, we know the $80,000 is the count, plus the $3,000 in goods that were going to arrive FOB destination. That would need to be included in their ending inventory, because the transfer of goods of title will not occur until they are received at the customer's location on January 5th. Sometimes a company's, Sometimes a company arranges for another company to sell its products under consignment. The goods are physically transferred to the other company, but the transferor, the consignor, retains legal title. If the consignee can't find a buyer, the goods are returned to the consignor. If a buyer is found, the consignee remits the selling price less the commission and approved expenses to the consignor. The sale is not complete or revenue is not recognized until an eventual sale to a third party occurs. As a result, goods held on consignment are included in the consignee's inventory. While in stock, they belong to the consignor and should be included in inventory of the consignor, even though not in the company's physical possession. A sale is recorded by the consignor only when the goods are sold by the consignee and title passes to the customer. When the right of return exists, a seller must be able to estimate those returns before revenue can be recognized. The adjusting entry for estimated sales that returns reduces sales revenue and accounts receivable. Now at the same time, cost of goods sold is reduced and inventories increased. As a result, a company includes in inventory the cost of merchandise sold it anticipates will be returned. Let's take a look. Exercise 8.6. So Bluebird Company's inventory balance on December 31st of year 1 was $175,000 based on a 12/31 year 1 physical count before considering these transactions. Goods shipped to Bluebird FOB destination on December 20th, year 1 were received on January 4th, year 2. The invoice cost was $40,000. Goods shipped to Bluebird FOB shipping point on December 28th, year 1 were received on January 5th, year 2. The invoice cost $18,000. Goods shipped from Bluebird to a customer FOB destination on December 27th, year 1 were received by the customer on January 3rd, year 2. The sales price was $42,000 and the merchandise cost $24,500. Number 4, goods shipped from Bluebird to a customer FOB destination on December 26th, year 1 were received by the customer on December 30th, year 1. The sales price was $21,500 and the merchandise cost $14,200. Goods shipped from Bluebird to a customer FOB shipping point on December 28th, year 1 were received by a customer on January 4th, year 2. The sales price was $27,500 and the merchandise cost $12,500. So our job is to determine the correct inventory amount to be reported in Bluebird's year 1 balance sheet. So, goods in transit, remember, depends on the terms between the two companies as to if it should be included in inventory or not. If it's FOB shipping point, legal title changes at the point of the shipment when they go to the common carrier. And from there, the goods have transferred, the sale can be recorded, and now the purchaser is responsible. If it's FOB destination, the seller is responsible for the shipping and the legal title will not pass until the goods arrive at their destination. So goods are being shipped to Bluebird FOB destination, but they weren't received until January 4th of year 2. Therefore, we know that would not be included in our inventory. The next one would be goods are shipped to Bluebird FOB shipping point, so in that case they would be included. Third, goods shipped from Bluebird to a customer FOB destination don't get received by the customer until January 3rd. In this case, they would be included in our inventory. Goods shipped from Bluebird to a customer FOB destination on December 26th were received by the customer on December 30th. They would not then be included in our inventory. And then last, shipping point, they would also not be included. Goods shipped from Bluebird to a customer FOB shipping point on December 28th were received by the customer on January 4th. They were shipped on 28th. FOB shipping point, to me, that means they should be shown in our inventory. Goods shipped from Bluebird to a customer FOB shipping point on December 28th. They were received by the customer on January 4th. Guys, I don't know on that one. I think it should be included in Bluebird's inventory because it passed the shipping point on December 28th. So our ending balance would be the goods shipped to Bluebird FOB shipping point, and they were received on January 5th. We would add that. We would also add goods shipped from Bluebird to a customer, received by the customer in year 2. Oh, I'm saying the same thing. It's correct. They should not be included in the inventory, and they're not because they transferred title. So I'm sorry about that. So our total inventory in this case should be $217,500. The cost of inventory includes all necessary expenditures to acquire the inventory and to bring it to its desired condition and location for sale or for use in the manufacturing process. Obviously, the cost includes the purchase price of the goods, but usually the cost of acquiring inventory also includes freight charges on incoming goods borne by the buyer, insurance cost incurred by the buyer while the goods are in transit, if shipped FOB shipping point, and the cost of unloading, unpacking, and preparing merchandise inventory for sale or raw materials inventories for use. The costs included in inventory are called product costs. They're associated with products and expensed as cost of goods sold only when the related products are sold. Purchase returns and purchase discounts represent a reduction in the purchase cost of inventory. Freight in on purchases is commonly included in the cost of inventory. These costs are necessary to get the inventory in location for sale or use and can generally be associated with particular goods. Freight costs are added to the inventory account in a perpetual system. In a periodic system, freight costs are added to a temporary account called freight in or transportation in, which then is added to purchases in determining net purchases for inclusion in cost of goods sold. The account is closed to cost of goods sold along with purchases and other components of cost of goods sold at the end of the reporting period. From an accounting systems perspective, freight in also could be added to the purchase account. From a control perspective, by recording freight in as a separate item, management can more easily track its freight cost. Shipping charges on outgoing goods, freight out, don't get included in the cost of inventory. They're reported in the income statement either as part of cost of goods sold or as an operating expense, usually among selling expenses. If a company adopts a policy of not including shipping charges in cost of goods sold, both the amounts incurred during the period as well as the income statement classification of the expense must be disclosed. A buyer views a return as a reduction of purchases. When the buyer returns goods to the seller, a purchase return is recorded. In a perpetual inventory system, this means a direct reduction in both inventory and accounts payable, if the account has not yet been paid at the time of the return. In a periodic system, a purchase returns account is used to temporarily accumulate these amounts. Purchase returns are subtracted from total purchases to calculate net purchases. The account then is closed to cost of goods sold at the end of the reporting period. These discounts really are quick payment discounts because they represent reductions in the amount to be paid by the buyer in the event payment is made within a specified period of time. The amount of the discount and the time period within which it's available are conveyed in terms like 210 net 30, meaning a 2% discount if paid in 10 days. Otherwise, full payment within 30 days. As with the seller, the purchaser can record these purchase discounts either using the gross method or the net method. Conceptually, the gross method views a discount not taken as part of the cost of inventory. The net method considers the cost of inventory to include the net after discount amount, and any discounts not taken are reported as interest expense. The discount is viewed as compensation to the seller for providing financing to the buyer. The gross method views a discount not taken as part of the cost of inventory. So in this slide, we record purchases for the full amount of $20,000. The net amount considers the cost of inventory to include the net after discount amount. So we record purchases at $19,600, which is $20,000 minus the discount amount of 2% on $20,000. Note that the inventory account, not the purchases account, would be used in a perpetual system. Next, on remittance within the discount period, the discount amount of $280 is recorded as a credit to an account called purchase discounts under the gross method. Under the net method, they're recorded as net amount after discounts for the amount paid, the $14,000 minus the $280. So for payments made after the discount period, cash and accounts payable are decreased by the gross amount originally recorded, which is $6,000 under the gross method. Under the net method, the discount not taken is recorded as interest expense for $120, which is 2% of $6,000. The effect on the financial statements of the difference between the two methods usually is really immaterial. Net income over time will be the same using either method. There will be a difference in gross profit between the two methods equal to the amount of discounts that are not taken. So Covington Mattress buys mattresses from Simpson Manufacturing. Covington purchased mattresses from Simpson on August 16th and received an invoice for $12,000 with payment terms of $210 net 30. Covington uses the net method to record purchases. Covington should record the purchases at A, $11,880, B, $11,760, C, $12,000, D, $12,240. So using the net method, it's going to be at the $12,000 times 98%, so $11,760 is how they will be recorded. Our next one here is they buy mattresses, purchased mattresses, received an invoice of $12 using the gross method. In this case, Covington should report the purchase at $12,000. We're going to take a break here and start with the next slide.